And it's another day to make money in the markets right here in Lagos, Nigeria, and the global markets, wherever you play at this point. Here's what's coming up in the next 55 minutes. Well, we get the state of the Nigerian consumer as inflation stays elevated. What next for FMCG companies? Our new vehicle sales in Kenya surged 25% in early 2025, driven by accessible credit. And Kenya's leading telecommunications operator, Safaricom PLC, surpasses the 50 million customer mark on its mobile network. And it's great to have you join us. I'm Ladi Williams. Let's get a quick check on what's playing out with the markets at this point. I did talk about who's making money and who's not. We're seeing oil prices up this afternoon, buoyed by optimism over U.S. trade negotiations that would ease pressure on the global economy, and a sharper than expected decline in U.S. crude inventories. And we see the impact there. Brent still trying to get back above that $70 level. That's per barrel, but we're at 69 there, smack on, maybe flip over that before the close of trade, 0.76% up. WTI crude, that's the U.S. grade, that's at $65.85 a barrel, a bigger 0.90% uptick there. Investors still, watching out on what's playing out right there in the global space, and we're seeing that impacting the market there. It's all about demand and supply. What are the expectations? Let's get a check on the metals market now. Seeing gold prices, they're down at this point, extending recent declines as a U.S.-Japan trade deal and batch of strong tech earnings has boosted risk appetite and further sapped demand. That's for the safe haven, down 0.60%, $3,362 per ounce there. That's for spot gold. The U.S. gold futures is down a bigger 0.90%, $3,367. So it's all red right across board there for the metals that we track. Spot silver down a big 0.70%. So we're not yet above that $40 level per ounce for silver, still teetering there, $39. Platinum, big, 2.50% drop, but still holding on to the $300 level of the 1,300 level. Palladium, that's down 2%, $1,252 per ounce there. So that's a picture right there in the metals market. All right, to other markets now. Let's get a check on commodities at this point. We see Nigeria sits atop an enormous coal resource, approximately 650 million tons of proven reserves and 2.75 billion tons inferred. Yeah, the sector remains all but dormant. Coal outputs plunged from a heyday peak of 905,000 tons in 1959 to a mere 46,000 tons of coal equivalent by 2010, and no coal-fired power plants currently operate in Nigeria. Despite the nation's historical reliance on coal, several critical hurdles ranging from obsolete infrastructure, technical shortcomings, to policy complacency and a pivot towards oil and gas continue to suppress coal-based energy development. To help us unpack this now, we have Rosemary here as an analyst, financial derivatives company. Great to have you, Rosemary.
Good afternoon, Ladi. Thank you for having me on the show.
Yeah, great to have you. So why hasn't Nigeria, capitalized on its massive coal reserves? And, what barriers, block coal power plant, development? We know it's the dirty alternative, according to some other think tanks.
Well, Ladi, just as you rightly said, there's an overwhelming list of factors that have dampened the exploration of this commodity in Nigeria. For one, there is the infrastructural barrier, there is the financial barrier, there is the environmental barrier, and there's a bit of policy inconsistencies here and there. On the part of infrastructural deficiency, Nigeria lacks adequate rail and port infrastructure to be able to move this commodity from the reserves to the industries where they are going to be produced and down to the ports where they are going to be exported to countries that actually use this resources. For example, we have the Eastern Rail Line that is supposedly to link coal fields and coal reserves to Port Harcourt, where they will be exported. And this rail line has been in disrepair for decades, and this has made the exploration of this commodity economically unviable. Now, on the part of the financial barrier, we global lenders like the World Bank and the International Financial Corporation are halting financing coal-related projects because they are trying to align with global decarbonization goal. An example of this is the coal to power initiative in Enugu that is supposed to generate about 450 megawatts of electricity. And I think it was established under former President Goodluck Ebele Jonathan's administration back in 2015. So it has been underfinanced and it has been abandoned because of this. And if you look at environmental factors, Nigeria has abandoned the Nigeria Roadmap project that is established in 2012 because it has revived the Paris Agreement in 2017 because it agreed or it pledged to reduce its greenhouse gas emission by 20% and a further 45% by the end of 2030. And also big players, the major consumers of coal like the European Union, China, and the US are aggressively adopting renewable energy sources. So we are seeing this subdued demand globally, made
Right.
the exploration of commodity economically unviable.
All right, so, given coal's historic role in, power generation and, current price volatility, how do you think the 2024-2025 price slump how do you see that impacting coal-reliant economies and industries that are making that shift, to renewables?
Well, the impact on coal-dependent economies is a double-edged sword, actually. On one hand, we have industries and economies that are dependent on the use of coal. Like for industries, we have the cement and steel refining companies that use coal for power generation, and for them, it's going to be a plus because it's going to make power generation cheaper, and it's also going to benefit developing countries also because they use coal as a primary source of energy generation. Now, on the other hand, for countries that export coal, like the likes of Indonesia, Australia, and South Africa, it is going to greatly reduce their export earnings because coal prices actually fell from $125 to around $111 per ton. It's going to reduce their export earnings. It might even reduce investment into coal mining sectors and industries within those countries, cause job losses, and put fiscal pressure on those countries. And that might really affect them, especially regions that depend heavily on coal royalties. Now, when you look at the countries that are transitioning into renewable energy, the cheaper coal is going to temporarily make energy generation cheaper when you look at that, but it's not going to completely halt or stop the transitioning into cleaner energy because of several factors. For instance, policies that supports the adoption of renewable energy,
Right.
carbon prices, which are taxes that are paid on carbon emission for bigger countries. They are about $90 per ton on carbon emissions.
Okay.
So these factors all play around to dampen the demand for coal and going forward.
All right, well, we'll keep tracking that, but thank you so much, Rosemary Hira, there, for bringing us the details of what's driving coal there. Thank you so much.
Thank you so much for having me, Ladi.
All right, so we see Nigeria and West Africa set to improve, its oil and gas sectors. Plans are underway to stop depending on Europe and Asia to set fuel prices and build a benchmark that reflects, regional realities. The Chief Operating Officer of the Nigerian Midstream and Downstream Petroleum Regulatory Authority, Farouk Ahmed, disclosed this on the sidelines of a Global Commodity Insights Conference on West Africa's refined fuel market in Abuja. Take a listen.
So the idea is we have been, as a country, major consumer of petroleum products, and then also currently the way as Dangote refinery comes on stream and improving in terms of production capacity, and other refineries around the West African coast like Senegal, Ghana, Niger, Cote d'Ivoire, that we see the need for price and benchmarking for West Africa. Because as we import products into West African region, the bulk of the assessment is based on Northwest Europe, Mediterranean Sea, Mediterranean, Arab Gulf, and other like Singapore.
So we're at the cusp of the regional market developing. Nigeria is a great growth story. West Africa is a great growth story. And so this market now has the potential to really come into its own. At S&P Global Commodity Insights, we have 100+ years experience of developing commodity benchmarks. And that's why we want to be early in the dialogue, partner with the NMDPRA to facilitate the discussion and to see how over the coming years regional price benchmarks can develop.
All right, according to data, in Nigeria today, quality has overtaken price as top consideration for fast-moving consumer goods buyers. A notable shift, highlighted in the 2024 Geo poll across sub-Saharan African markets, where we saw about 60% of consumers prioritize quality over quantity, and 33% cited quality as the most important purchasing factor, edging out price there at about 31%. Let's discuss this and other matters now impacting the FMCG companies in Nigeria. And joining us for this, we have Mohale Eluenu, who's the MD, PZ Cousins Africa, joining me right here in the studio. It's great to have you.
Hi,
welcome.
Thank you so much for having me. It's an absolute pleasure.
Fantastic. So, definitely it's the same old issues, at this point. And we're trying to, gauge the state of the Nigerian consumer. Data, from June, inflation, we're seeing headline inflation there still 22.22%, even though it's, due to the methodology, it's no more in the 30s, at this point, but still elevated. Then we have other indicators there, talking about business expectation survey from the CBN and consumer expectation survey, what they're seeing for inflation, in the months ahead. And we see improvement there, according to the data. But, talk to me about how business is looking, for your sector, in the first half of 2025. Is it better?
No, in the sector, it's definitely, we're going through the same challenges as the broader Nigeria macroeconomic thing. We have the same turbulence, right? The same headwinds, whether that's inflation, energy prices, devaluation. These are challenges that mean volumes are strained because of lower consumer purchasing power, but also within our P&Ls, it's definitely tough because we have to figure out innovative solutions to mitigate the headwinds we talk about and ensure we can deliver margin resilience or, where possible, deliver margin accretion. So right. Yes, it's a tough one. We've been able to navigate it better than most, but again, that's due to a very tailored, integrated set of solutions to try to tackle this, as well as a spectacular organization that has gone above and beyond to make this happen at PZ Cousins.
Right, and you did mention, foreign exchange market, and, the central bank governor says there's been stability, since, mid-2024, into 2025. Are you seeing that?
Mid-2024, yeah.
That's good for business, at this point, stability.
Yeah, people are going to tell you at 1,005.
Even though I am not comfortable at those levels.
At those levels, yes.
1.5. I don't like 1.5.
For the consumer, 1,535 to $1 is always going to be severely challenging, especially when you compare that with June 2023, when it was about 400, or even at the black market, 700, 800. However, from a business perspective, the key word is stability to enable planning, preparation, forecasting. And what has happened is, as it has stabilized, even though at high levels for the consumer, and definitely detrimental to the consumer wallet, we are able to plan more. Because that stability enables us to forecast, enables us to build our revenue growth management measures and figure out our sourcing interventions in order to kind of chart our way towards profitability. So yes, from a business standpoint, that stability has been beneficial. You've seen it across the sector. You've seen those who've navigated it better are delivering strong growth, double-digit growth in terms of revenues and return to profitability. From our side, we've been able to, I don't want to kind of spook the auditors, but we've been able to do that, delivering revenues in our Nigeria business, over 40% growth, PZ Cousins Nigeria, and also return into profitability. So yes, from a business standpoint, not necessarily from a consumer wallet standpoint, but it's been, that stability has translated towards being able to understand the indices that go into our business planning and our ability to respond to it in a very intentional, deliberate manner, and has minimized the shock or the shocks that often kind of toss us around whenever we kind of work towards our goals in a business standpoint.
And do you see this stability, continuing, going forward?
Oh, to have a crystal ball.
Yeah.
If I had that, I would probably be doing something else,
Right.
making a ton more money. No, the trends tell us yes. And maybe that's a bit of wishful thinking and optimistic. Nigerians were ever optimistic, but the trends tell us, right? When you see that banking, all of a sudden, your Naira card can get you dollars. When you see that there's an ability to access FX, when you see the delta or the premium between the parallel black market versus the official market narrowing to almost a Naira over the last few weeks, it portends that growth. Clearly, foreign portfolio investors are finding Nigeria a versatile or virile hunting ground, and that's happening, right? You think about energy, petrol prices now. It's not exponential, but you see those decreases to 890 when something was topping over 900, 1,000 a few months back. So you take a look at that, and there's some positivity, right? Our Q1 GDP numbers showing 3.3% growth, not where we need to be, because you need to more than double your population growth for the gains to translate across the entire population and impact all socioeconomic sectors and categories. But still, that is a good portent.
Mr. Rouhani said, happy data, unhappy people. No, we don't want that.
No, we don't. No, we don't.
At this point. So let's look at the consumer
Okay.
at this point. From your view, we've seen your sales, revenue, and all of that. How resilient is the Nigerian consumer so far?
The Nigerian consumer is the embodiment of resilience, right? If you look into the dictionary and you look up resilience, you will see a picture of the Nigerian consumer. I kid you not. Try it right now.
Right.
But yes, that's not to say the Nigerian consumer is not dealing with incredible, crushing headwinds, right? The Nigerian consumer has been through a lot over time. It's not necessarily just in the last couple of years, over time. But yes, they continue to remain resilient. We continue to show optimism and positivity. We see that in some of the businesses that we do, right? I just talked about our revenue growth and our return to profitability. That's driven by a consumer that, despite these challenges, is still voting with their wallet for quality products that will improve their lives, products that they trust, products that give them value. Right, so you see that, right, and you still see it. Yes, there's still travel involved in Nigeria. Nigerians still take out the weekend to enjoy themselves. Owambe hasn't died.
Right.
There is that resilience, and that's why it is important to note that for businesses, whether multinationals or locals, this is a great place to do business, because the consumer, that is 200 million people in Nigeria, right? An economy that is showing positive GDP growth. And it's one for the future with a median age of 18. One that demonstrates and continues to demonstrate resilience, and it's one for the future. It's great for companies to come invest and keep growing in Nigeria, because it's a perfect circle of reward, right? You get to employ, increase our employment levels, and at the same time, the companies can benefit rewards from investing and staying in this market,
right,
which is what we definitely intend to do today and for the long term.
Right. I'm talking about you at this point. We know some FMCG companies have been accused of shrinkflation. At this point, you reduce the sizes and you still charge the same price, at this point. How are you seeing all of that play out?
Oh, I mean, the consumer, it's an interesting one, and it's a great question. Shrinkflation is part of that is because it's the company's way of ensuring margin resilience. Companies still have to they're responsible and accountable to their shareholders. They still have to make profit and ensure they adapt or adopt sustainable business models that ensure they are here for the long term. So they will take options like this. In the industry, we call it price pack architecture. The consumer will say shrinkflation, where you kind of play with your packs, your pack size, your pricing points, and come up with different products that target different consumer segments, different consumer purchase, and usage occasions, right? So yes, that is a thing, and it's for the company's long-term health. But at the same time, there are consumer benefits to this, right? We find that consumers in Nigeria, for example, the different, massive diversity from a consumption, but from a socioeconomic population standpoint, right? We talked about GDP now, new numbers coming in, $243 billion, right? That's great, but at the same time, your GDP per capita is just about...
Some economists say not so great.
Not so great, but yeah, that's what I'm saying. The per capita is about 1,000, roughly 1,000. So obviously that's not translating, like Rwani says, happy data, not happy people.
Right.
Which means, as a company, you need to find a way to target products for different strata, socioeconomic consumer groups within the population. Be shrinkflation, or what you do with products, different sizes, different packs, different price points, is critical to be able to delight consumers, no matter where they come from, right? Geographically, but also socioeconomically. So it's a delicately balanced on the knife edge, but there are benefits for the consumer and there are benefits for the company too.
So everyone wins, at this point, somehow.
Everyone is in a dance that ensures they stay afloat.
Thank you so much. It was great having this conversation with you. This is Ogale Leon, who's the MD, PZ Cousins Africa. Thank you for coming in today.
No worries. Thank you for having me, and do have an awesome day.
Thank you.
All right.
All right, now let's look at some other issues. Now, at this point, as the Genius Act is signed into law, that's July 18, 2025, it ushers in the first comprehensive U.S. federal stablecoin framework, creates fresh dialogue about how these rules intersect with Africa's dynamic fintech, landscape. Key provisions mandate a one-to-one backing with the U.S. dollar or high-quality liquid assets, segregated reserves, monthly disclosures, audits for large issuers, and priority user protection at the insolvency event. Well, join us to unpack this now. We have Chris Morris, the CEO, Yellow Card, joining me via Zoom. Great to have you in the show, Chris. Yeah, so I see your mouth moving, but I can't hear you. I think you have to unmute, Chris. But while you're doing that, definitely it's all about the Genius Act, at this point. And, here we're trying to understand, what lessons, Africans can, learn, from the regulatory environment that can inform, U.S. and global stablecoin regulation, under frameworks, here, because it's huge, at this point. The Genius Act. What kind of act should Africa be looking at, at this point? But unmute before you respond.
Yeah, I mean, I think the big thing that Genius Act is doing is it's giving some regulatory clarity from the U.S. level to a technology that's already being used everywhere across the continent and everywhere across the world. So, with U.S. dollar stablecoins, you have, like you mentioned, right, one-to-one backing with the U.S. dollar. And this technology is being used to make the dollar more efficient and more effective all over the world, right? It's changing the way that people interact with the dollar, the way that the banking system uses the dollar in, countries across Africa and countries across the world. And now with this bill and with this legislation, I think that you're going to see a lot more adoption of this technology. And what that means is more efficient trade. What that means is more efficient international payments, more efficient access to dollars in countries that previously have had difficulties or issues with liquidity and access to the dollar. So I think you're going to see just a lot more efficiency in global trade as this technology continues to progress.
Right. All right, Chris. So I'm going to put you on the spot here a little bit. We've heard conversations and arguments about the U.S. dollar and the U.S. losing their status as the leaders there. We know the dollar is right there in most trades, international trades at this point, over 80%. Do you think with the U.S. pushing for, stable coins and, dominance, in that market there with issuance, do you think this keeps the dollar ahead, going forward?
Yeah, look, 100%. And I think that, this is a big part of the reason why this was such an important act and such an important piece of legislation for the Trump administration. Is, look, essentially all of history, right, all of recent history you've had countries around the world using the U.S. dollar for international trade, but they're using it through SWIFT. They're using it through a correspondent banking system where if I need to send money from Nigeria to Kenya, that permission shouldn't have to come from New York to make that transaction just because I'm using the dollar. And so, you've had this correspondent banking system and this system of using the dollar for international transactions that was just never set up for countries outside of the U.S., right? It was never set up for the rest of the world. It really only benefits the U.S. And I think that, with stablecoins and with this technology, what you're starting to see is that opening up, right? Countries and banks around the world are able to interact with the dollar, to use the dollar in a way that they weren't before, and they're able to move that money around the world frictionlessly, without SWIFT, without correspondent banking. And this act just adds a layer of clarity and protection to that.
Right, and talking about SWIFT at this point, I guess if we get full adoption, for stable coins at this point, it's going to be hard to actually, take some countries out, from stable coins the way, the U.S. and, all the top countries can do it, with SWIFT. I guess that would be a thing of the past where we see full adoption, of stable coins. But do you see opportunities, for businesses, like yours to integrate, USDC in emerging markets now that it's, recognized under U.S. federal standards?
Yeah, look, I think that you're going to see. Look, when you look at Africa, right? You're talking about the continent that has the most adoption of this technology already, right? And the most usage of any continent, right? When you look at Nigeria specifically, right? It's the the #1 country in the world, and that's a Visa stat. That's not a Chris stat, right? For adoption of this technology, and so I think that what this legislation is going to do is it's going to make it much easier for banks and for large financial institutions to get involved, right? People are already involved. People are already using this. Businesses are already using this technology every day. So, it's not about how do we, get businesses to start using it. It's how do we get every business using it. And I think that, the banks and the financial institutions that people and businesses rely on, utilizing and adopting this technology is going to be a big piece of that. And look, I can tell you, just within the last few weeks, especially since the original Senate vote on the Genius Act, we've been reached out to by a number of banks, right, across the continent, across multiple countries, right, very large banks, prominent banks that are now interested in how do we utilize this technology, right? How do we use this to move money outside of SWIFT, outside of the correspondence system? So I think you're going to see a lot of adoption from large financial institutions on the back of this, and you're also going to see a much swifter promotion of regulation across the continent now that there's a framework available from the U.S.
Right, and as you mentioned there, African markets benefit from stable coins as payment bridges. We're seeing that with a lot of adoption, in Africa. But there's also the argument that the U.S. stable coin regulation may lead to, fragmented license tiers. How do you think this could affect interoperability?
Yeah. Look, that's a great question. So the reality is, I don't think that we're going to live in a world where there's only going to be one stable coin, right? I think that where this bill specifically is heading, and where this technology is heading, is you're going to see banks across the U.S. and frankly banks across the world issuing their own stable coins. And you've already seen announcements along these lines from J.P. Morgan, from Citibank, from Bank of America, from other major U.S. banks. You've seen it from some big European banks. I can assure you that African and other continents will follow as well in terms of announcing stable coins and other initiatives like that. And so you're going to end up in this world where banks all over the world, large financial institutions all over the world have their stable coin and have their own sort of dollar, right, and tokenized deposits and all of that. And then you'll have various tools, right, both on and off chain. And look, I mean, this is part of what we do, but there are a number of tools that are going to pop up on chain, off chain, et cetera, that will ensure that that interoperability is always there across different chains, across different stable coins, et cetera. So you'll live in this multi-stable coin world, but it will still feel like you're using the dollar, right? Everything will still aggregate into a USD balance at the end of the day.
Right. At this point where we're pegged, at this rate. But, looking at, the digital asset space, I remember there was a time where there were not more than maybe 100 or 200 digital assets, in the space. But right about now, it seems anyone can issue, a digital asset, at this point. And we've seen over 2 million altcoins or more, at this point. So, as banks and large platforms, issue their own, stable coins, how would your business maintain competitiveness in, Africa's remittance corridors?
Yeah, look, I mean, you're right. Everybody has their own token now, right? Everybody but you, brother. We're just waiting on you, man. We need you to launch
I need to launch mine.
Channels TV token. It's coming,
yes.
baby. That's it's going to 1 million. Look, I think as everybody keeps launching their own tokens and all of that, the big thing to remember is that there are a lot of meme coins. There's a lot of stuff out there that should largely be avoided. And there are a handful of stable coins and major market cap cryptos, right? The Bitcoins and like that are still great for either savings, transactions, anything like that. I mean, in terms of how do we keep up with it, right? How do we maintain? It's about being able to support all of the major options. Right. The reality is that by supporting, a handful of chains and a handful of, stable coins, you're supporting over 99% of the volume. Right. So, there are, again, there's 1,000 tokens being launched a day, but, most of them don't get any real play. Right. If you support the major stable coins, the major chains, you're supporting, 99% of sort of global volume.
All right, so, looking ahead at this point, sometimes I try to look into the future with all of this talk about, artificial intelligence, stable coins. It just seems like everything might be decentralized, going forward. I want to know what you're seeing, going forward with this Genius Act.
Yeah, I think that this is going to really change the way that banks and countries around the world interact with the dollar. And like I said at the beginning, I think that this is going to make international trade, it's going to make invoice settlement, access to the dollar, all of that so much easier for international transactions, right? I don't think that this changes anything about the way that business is done locally on the ground in most countries, but it certainly changes the way that people think about and interact with the dollar for international transactions. Because now all of a sudden those transactions are becoming a lot less expensive. They're becoming a lot easier to facilitate. They're becoming instant, right? And they don't have to go through several layers of approval. So banks in emerging markets, right? Banks all over the world are able to control and hold their own dollars rather than having to ask for permission from New York, right? And so it's becoming a much more open and global ecosystem. And you're going to end up in this world again where accessing finance, accessing financial services, global trade, all of that is going to be easier than it ever has been.
We'll definitely be looking out for that future. But thank you so much for breaking it down for us. That was Chris Morris, who's the CEO of Yellow Card. Thank you for joining us today.
Thank you, sir.
Welcome back. We have Willie Bong with the details at this point, and she's wearing red. Hope it doesn't mean what I think it means.
Like I've told you before, I align myself with the Chinese culture, and this is just saying there's positivity in the market. Yeah, from Chinese culture.
When Will sees red, she says good.
Yeah, definitely. So let's look at what's happening in the major equities that we track in Africa. They were mostly positive as intraday. Nigeria's NGX traded higher. We see it up 0.07%, still holding on to 132, climbing higher, possibly 133 at the close of business. We'll keep our fingers crossed for that. But let's look at the JSE in South Africa. That was trading down 0.16% at the time I took the numbers. Profit taking definitely ascertained. We did see the JSE cross that 100,000 mark yesterday. Very historic for the that exchange. But we see profit taking, hoping there'll be a rebound at the close of business. Elsewhere, Egypt's EGX is on holiday today, Thursday, to mark the July 23rd revolution. It closed Wednesday up 0.95%. See that on the screen. And Kenya closed Wednesday's session also in positive territory. It was up 0.66%. But let's look at what's happening in Nigeria. We see Airtel Africa has posted a remarkable 269% year-on-year increase in pre-tax profits, reaching $273 million for the quarter ending June 30th this year. Now, this performance accounted for 41% of its full-year pre-tax profit. The company also recorded a 108% jump in profits after tax to $156 million, supported by a 22.4% rise in reported revenue, $1.41 billion, and a 24.9% increase in constant currency. Now, the growth was underpinned by a 9% expansion in its customer base and a 17.4% uplift in data subscribers to 75.6 million, reflecting sustained demand and operational excellence across its markets. Now, with that done, let's move to the fixed income space and see how the result of the NTB auction panned out yesterday. We have Caleb Alimi, Chief Dealer, Providence Bank, to share that with us. Good afternoon, Caleb, and more discussions.
Good afternoon, Will. Thank you for having me.
Caleb, we did see the CBN, the DMO, raising $290 billion in the NTB auction that was held yesterday. Is there any fallout from the MPC decision? Did it filter in to the activities at the auction yesterday?
Not exactly. The activities or the decision of the MPC to hold the monetary policy rate stable did not affect the fixed income market at all. What we've seen instead is an intricate play of demand and supply. As you see from the results you displayed earlier, you could see that interest rates at the NTB auction yesterday dropped significantly from 15.74 to 15% on the 91 days, from 16.2 to 15.5% on the 182 days, and from 16.3 to 15.88 on the 1 year. So what has simply happened is just that our market continues to sense that it appears the supply side is not so hungry for a lot of for high rates, so to say. And that's why market continues to drop. Liquidity wasn't so flexible yesterday. It wasn't so liquid. Market wasn't so liquid yesterday. Despite that, we still saw rates drop. About 320 billion matured on the 1 year paper, or generally about 320 billion matured, and DMO offered, just shy of 300 billion, about 290 billion. So we already see that they're looking to reduce how much they borrow, so to say.
Definitely, but we see, I think the DMO was leaning towards the 1 year paper. We see them offer. The offer was 220 billion, but we see 271 was allotted, while we saw subscription for that over 600 billion. What does that tell us about the 1 year paper? Why is the 91 and 182 paper not the toast of investors?
Well, it's a yield play. The longer you hold fixed income securities, the more you earn on them. So if you're holding 15% for 91 days, you don't earn as much if you hold 15% for 1 year. And that's simply what the investors are looking at. They're looking at better returns for their monies. And you also mentioned that, it seems the DMO skewed more to the 1 year paper, even in their sale. The 1 year paper was the highest on offer, and, and they did oversell, but the total size they still sold was the 290 billion, which was offered.
Okay, so let's just shift our gaze now to the bond auction, which is going to take place on Monday, July the 28th. What do you see play out there? What are your expectations for that? Because what we should note is that in terms of the offer, we have the 5-year tenor, which is 20 billion. That is short of we saw that range when we had a calendar, 40 billion to 60 billion. But right now, we're having 20 billion for the 5-year and 60 billion for the 7-year bond. Why that disparity, especially in the numbers, and away from the calendar that was issued earlier?
Yes, again, this just supports what I said earlier about the market sentiments around the supply side. You can see that the previous auction, 100 billion was on offer, and at this auction, just about 80 billion is on offer. Even though there's more on the 2032 maturity, but we still see that generally the size on offer has reduced. It was what the calendar said was 40 to 60 billion on both sides or for both maturities, but you can see that even on the shorter one, the 2029, only 20 billion is being offered. And that's not far-fetched. Over the last 3 auctions or thereabouts, over the last 2 auctions, the 2029 paper has attracted the least interest. The auction in May, they sold only about 4.7 billion. Subscriptions were just about 16 billion. The auction in June, they sold only about 1 billion. Subscription was around 41 billion. So it's not far-fetched that they reduce the size on offer at the 2029 paper, the 5-year paper. However, for the 2032, they slightly increased it, but we still see that generally what they're looking to do is offer less than what they offered the first time. What we expect to happen at the auction is a significant drop in the rates. The last auctions closed at 17.75 and 17.95 for both of them. We should see at least 150 basis point drop in the stop rates for both of them. We should probably see the 2029 close around the 16.7 handle, and the 2032 paper close maybe around the 16.5 handle. And that's if, investors are maybe show a bit of apathy and then the government needs to sell more. Other than that, it probably drops below 16.5%.
Thank you so much, Caleb. What we just see play out is still the impact of CBN holding the rates 3 consecutive meetings. That's a drop in yields in the near future for fixed income markets and the papers in that space. Thank you so much, Caleb Alimi, Chief Dealer, Providence Bank, for sharing your insights on Business Incorporated.
Thank you. Enjoy the rest of your day.
So let's look at the stocks in the Gulf, Middle East. They traded mostly positive at intraday. We see Dubai up 0.23%. Abu Dhabi also up, inching up just 0.06%. Now, still within the region, we see the Tadawul Wilders in Saudi Arabia also bucking that trend, trading negative 0.38%. And Qatari index also is up in opposite direction, 0.3%. Let's look at markets in the U.S. now. S&P 500 futures were little changed early on Thursday as big tech companies reported a mixed bag of earnings Wednesday, and investors again turned their attention to the ongoing feud between President Donald Trump and the Federal Reserve. We see the futures tied to the S&P 500 up 0.03%, Dow Jones down 0.4%, and Nasdaq added 0.26%. But let's look at what happened yesterday with our correspondent, Maria Bird.
U.S. stock market climbed on Wednesday as the United States and Japan struck a trade deal. This trade deal had a positive impact on the U.S. stock market, as this trade deal will allow for major investments by Japan into the U.S., also allowing for the U.S. to reduce its tariffs on Japan by more than 10%. This trade deal has many hopeful that this could mean a positive impact for the global marketplace. While the Dow Jones saw a tick up of 1.1%, the S&P 500 climbed to 0.8%, and the heavy tech Nasdaq was up at 0.6%. Many are hopeful that these trade deals could mean positive signs for the U.S. stock market for days to come.
Thank you, Maria. Meanwhile, the White House said that President Donald Trump will visit the Federal Reserve on Thursday, escalating his pressure campaign against Fed Chair Jerome Powell. This is the first time in nearly 2 decades that an American president will be making an official trip to the central bank. Now, let's look at Asia markets very quickly. We see that green for Asia bouncing off the latest trade developments between the U.S. and Japan. Positive signs for a deal with the European Union as well, but I'm sure Emily will be able to share what's happening in the EU.
We'll hear more definitely from Emily as Trump sets to visit the U.S. Fed. That'll be very interesting, to watch. Now, but let's head to Berlin for a look at European markets. We have Emily Lachner there. Great to have you, Emily. What are investors keeping an eye on over there?
Hi, Ladi. Well, they're keeping a very close eye on the potential trade agreement between the U.S. and the EU, I think as everyone is. Officials say that a deal is likely, that it could soon be nearing. That's about 1 week ahead of the August 1st deadline. We'll have to wait and see. But investors will also be watching the European Central Bank, which is expected to hold its deposit rate at 2%. And they'll also be keeping an eye on Germany, where I am. The latest economic indicators are showing that business activity grew last month and manufacturing output increased for a 5th consecutive month. That's very good news for an economy that has been struggling for the last couple of years. And Europe's car market, on the other hand, saw a sharp 7% year-on-year drop last month. Germany, France, and Italian car makers posted especially steep declines. So a bit of a mixed bag, but ultimately everyone is anticipating the news about the U.S. and, EU and U.S. Trade agreement.
Yeah, and you mentioned, the U.S. and EU maybe closing or getting close to reaching a trade deal there. How soon would it be?
Yeah, I mean, at the moment, it appears a deal is likely to go through. That deal would mean that the majority of exported EU goods would be hit with a baseline 15% tariff on arrival into the U.S. This includes cars, which are currently being taxed with a 25% levy. So a general 15% baseline tariff, though certain goods would still see very high tariffs, like steel and aluminum. That's if they are imported over a certain quota. These shipments could be hit with as much as a 50% duty. But EU officials are optimistic that it can be reached. That includes German Chancellor Friedrich Merz and French President Emmanuel Macron, who met in Berlin yesterday and reportedly spoke to one another about how close the EU was to securing an agreement. U.S. Treasury Secretary Scott Bessent also told Bloomberg Television that he thought the Trump administration was making good progress with the EU. So a lot of good signs there. There's a sense of confidence in part because the EU has slightly shifted its negotiation tactics this time around, and also because the U.S. has reached a deal with a number of countries in the past few weeks, including the UK and Japan. But officials are still really cautious because they've been here once before with Trump.
Right. I guess we'll wait and see at this point. Thank you so much, Emily Lashner, for breaking it down for us.
Thank you.
So another conversation now. We see Africa's data center market is entering a period of rapid expansion, fueled by soaring digital adoption, government-led policies, and rising demand for low latency, secure infrastructure, investments into local and international compute facilities, ranging from their third and fourth hyperscale campuses to emerging edge nodes. That's reshaping the data landscape as internet penetration crosses 30% and smart city and AI initiatives, that's gathering momentum at this point on the continent. Well, joining us to unpack this now, we have Olakunle Ribisala as the lead business intelligence analyst there, joining us via Zoom. Great to have you on the show. Hello, Olakunle, can you hear me?
Hello.
Yeah, Olakunle, great to have you, Olakunle. So, definitely a lot of talk about data centers at this point. We're seeing a lot of big tech companies investing, AI companies investing in data centers. Talk to me about the key opportunities that, make Africa an attractive frontier for data center, expansion. What are you seeing there?
Thank you very much, Larry, for having me. This is a very great opportunity for Africa as a whole because there's this culture of data awareness that's going to come along in terms of, how the youth, are able to come along with different parts of AI and technology in Africa. So data centers are the backbone of everything digital, from streaming to banking to cloud storage. Right now, most of Africa's internet content is hosted outside the continent. So it increases cost and also slow down speed and creates security risk. So, but that's changing. Africa has the ingredients to become the next big data center destination, and here's why. One is talking about the population and the digital demand. So Africa has the world's youngest population and the rapid, growing internet user. More people online means more data generated. Hosting this data locally makes business and technical sense. So Nigeria alone has about 200 million people. There's a massive demand for faster, cheaper and digital services. And also talking about the mobile first ecosystem. So most African connect to internet through mobile. This creates unique data patterns that global providers are now paying attention to. Local centers can process this traffic more efficiently, improving user experience and reducing reliance on overseas, servers. Then also talking about the rising cloud adoption, which is the worldwide thing. So cloud services in Africa are growing very fast. Companies, governments, banks, and even schools are moving online. So local data centers keep this data closer to home, lower cost and meet data protection regulation. Multinationals, like Microsoft, Amazon, and Huawei are already investing here already. So I'm also talking about the economic diversification for countries like Nigeria, investing in data infrastructure, the smart way to move beyond just oil that we do have. Data centers create job, construction, construction company, power, networking, engineering, and the likes. Thank you very much.
All right, Olakunle, there you mentioned the benefits there of data center, but for some of our viewers that don't understand what a data center is, help me break that down. And also for an investor maybe sitting on cash right now and thinking where to pile that into, what would I need to invest or build a data center, and what are the possibilities there, the earning potential in me investing in a data center?
I'm just trying to get that right because this is quite bad. But let me just assume I get your question quite all right because of the sound quality. So talking about the data center, it's basically a special kind of building where powerful computers are kept to store, process, and manage digital transformation. So every time you stream a movie, make a bank transfer, you use a app, or you save something to the cloud, the data is being handled by computers sitting in a data center somewhere. So now investing in data center means putting money into buying the land, building the facility, installing high-tech servers, providing stable electricity and cooling system, and also making sure it has security and fast internet connection. So think of it like building a power station, but for information instead of electricity, basically. So now talking about why it matters in Africa. So right now, most of our data we use in Africa are hosted outside the continent. So that makes our internet slower, more expensive, and less secure. But if we build more data centers, we can keep our data in a local storage, create jobs, power local tech companies, and attract global tech giants who wants to work closer to African users. Thank you very much.
All right, so what are you seeing, going forward quickly now for data center investments in Africa? Do you see this as something that will see more investment, being piled into?
Yeah, of course. Data center investments in Africa is going to, like I mentioned, it comes with a lot of advantages. So it's going to bring a lot of benefits to the country or to the continent as a whole. So talking about the benefits, we can see. It's one of the smartest long-term investments you can make right now. So data is the backbone of everything today, like banking, healthcare, education, entertainment, and even farming. So, and if all our data continues to live abroad, we will always be paying more, waiting longer, and depending on others to power our own digital lives. So building data centers here means faster and cheaper internet service for everyone, more jobs for our youth, young tech-savvy population, better security because our information stays in the continent, and a stronger digital independence, especially as more Africans, governments push for local data storage. And also, this is a huge opportunity for economic diversification. Just like oil transformed economics in the past, data can be Africa's next big export. So if you are the ones hosting it, processing it, and managing it, so yes, data centers investment is not just good for for companies, but for the continent as a whole.
All right. Well, we'll keep tracking the growth there and see how investors are navigating that space. Thank you so much, Olakunle Ribisala is a lead business intelligence analyst. Thank you for coming on.
Thank you very much. Have a good rest.
All right. Very quickly now, see Safaricom PLC, Kenya's leading telecommunication operators, surpassed the 50 million customer mark on its mobile network, driven by sustained customer engagement initiatives leading up to its silver jubilee. There, and we see the group CEO emphasizing that the milestone reflects the deep trust and connection the company has cultivated over 25 years and reinforces its commitments to driving digital services like M-Pesa and Sambaza Furaha nationwide. All right, let's get a check on what's playing out in the crypto market there. And from where I'm sitting, it's red on the screen at this point with a couple of stable coins there having those green pockets. So definitely nothing goes up forever at this point. So we're seeing a pullback. Some say it's nothing, you know, at this point, but who knows? Maybe it's the beginning of a major pullback. We'll keep tracking all of that. But that's the show today. Thank you so much for watching. Laddie Williams from me and the team right here at Channels HQ. It's bye for now.